After Nvidia's blockbuster earnings lit a fire under AI optimism for investors. For more on the report and what it means for the broader markets moving forward, let's welcome in here Ryan Detrick, Carson Group Chief Market Strategist. Ryan, it is great to have you on the show. So, you look at Nvidia, as Julie was saying, Ryan, Nvidia reports, they beat. Street loves it, investors love it, the stock rips, but we look at the major averages, all three in the red here, Ryan. How do you explain it? What's going on here today's trade?
Back, Josh. I mean, you're right. Nvidia is the all-star today. It's been the all-star all year, we know. But just today, I mean, we'll see what happens the final hour. I know we've got an hour to go, so maybe some buyers step in. But my take is this. We've had a heck of a run right before today. The S&P's up over close to 6% for May. We've had a good run. Maybe it is almost just some sell the news. I know we're not selling Nvidia very much, but everybody had that bullseye all month really with this news. And it's not like anything major has changed. Maybe markets are just due for a little pullback consolidation. I'm not overly concerned so far today.
Hey, Ryan, it's Julie here. So how are you thinking about NVIDIA specifically and sort of tech more broadly? Everybody was anticipating those results. They came. They did better than expected. Now what?
Yeah, the joke I said before was death, taxes, and NVIDIA beats on earnings. I think those are three things we can always look forward to, or maybe not look forward to in some of those cases. But nonetheless, big picture, we're more neutral right here, technology, Julie, and it's not because we don't like it. It's just if you look at valuations like the last 20 years, keep this kind of simple. Tech valuations are like 2 standard deviations above their long-term average. That means they're really pricey. Doesn't mean you can't be in it. Again, we're more neutral tech. To us, we look at some of the other areas, financials, industrials are really cheap historically, and then small caps and mid caps. Now, I know those are kind of dirty words. A lot of people have talked about them before, but to us, the second half of this year could be more of a rotation, not necessarily out of tech, so to speak, but just into some of those areas that are a little bit cheaper. Again, as the economy is strong, we get into that if you want, and we think the economy is going to be strong and those areas should do pretty well.
And so Ryan, so financials and industrials, just let's drill into those a little bit. Is it just a valuation call or no, there's other variables at play there?
Great point, Josh. Other variables, I mean, plain and simple, we're pretty optimistic about the economy, right? We think this economy is going to continue to surprise the upside. We've seen earnings surprise the upside. We think those cyclical names will do better. Kind of put a bow on this productivity. We have not had strong productivity in our country for a long time. Over the past year, we've had about 2.9% productivity. That's pretty darn good. Josh, we think productivity can continue to stay strong going forward. And what does that mean? What does it mean to the listeners out there? The mid to late 90s was the last time we saw strong productivity. That's kind of that magic elixir that allows for GDP to come in better than expected and earnings. Remember last year, nominal GDP came in at 6%. We were bullish. We didn't think it'd come in at 6% last year. Nobody saw that, but a lot of that was probably strong productivity. So that's why we like the cyclical areas.
And so what are some of the specific cyclical areas that you guys, I mean, like I think of tech as a cyclical area too, but you'd rather look elsewhere here.
No, good point there. We would. I mean, specifically, financials and industrials are the two groups that we are overweight. Your materials and energy can lump in there. We're more even weight there. But I think, again, it's just where's the opportunity, right? What's the market? The market's always forward looking. I mean, there's a lot of earnings growth potentially going to come in the next 12 months from small and mid caps. People aren't talking about that. And again, the small caps, if you look relative to large caps, are as cheap as they've been in like 25 years. Now, just because something's cheap, it doesn't mean you want to go into it, but we're optimistic. We're going to see some better inflation data starting to come. We started to see rent prices start to crack a little lower. That should lead to OER. I don't want to get too in the weeds here. We know shelter is a big reason why inflation's been stubborn. We think inflation is going to really improve, and that can open the door for 2 Fed cuts. And again, small, mid caps, and cyclicals should benefit, in our opinion, the rest of this year.
And I know, Ryan, listen, we got a down day, but it sounds like you see the market continue to kind of move higher here over the summer. And it sounds, Ryan, like in part at least, are you letting kind of history be your guide there?
Yeah, we do. We think, look at history. I mean, I've come on with you guys for a while, and we've said election years, when you have a president up for election, been higher 10 of the last 10 times. You don't blindly invest in that. But what you tend to see in an election year also, Josh, is a summer rally. June and August usually aren't that great. They average about 1.3%, pretty good in election years. So we think, again, a surprise summer rally and even strength the rest of this year does make a lot of sense. But it comes down to the fundamentals. Earnings, profit margins, and CapEx, capital expenditures are all really strong. I mean, that's the main reason we're optimistic. And then we look at kind of history and think, hey, history doesn't repeat itself. It often rhymes. Mark Twain, we all use that. And we think we could have a summer rally and a good end of year.
Well, and it's interesting because you also note that this is on pace to be the best start to an election year ever. So what's that about, and how do we sort of contextualize that historically?
Yeah, might have jinxed it with the action
Uh-oh.
today, but yeah, I'm teasing. But I did that as of the end, the first 5 months of the year. 1976 is there, and again, usually election years aren't that strong to start off the year. Let's just keep it there. But this is quickly becoming one of the best election years we've ever seen, with a couple days to go this month. Now, here's Julie. What's interesting? Today's the 100th trading day of the year. What in the world does that mean? I looked back and found 20 times the S&P was up double digits as of the 100th trading day of the year, like we're going to be today, assuming we don't have a major sell-off the next hour. The rest of the year was higher 85% of the time, with an average return of 9%, median return of 10%, both those numbers well above the average returns. Long story short, a good start to a year historically has been great. One final thing, these years might ring a bell. 2021. 2019, 2013, 1998, 97, 96, 95. Those were the last years we had double-digit returns on day 100, and every one of those years gained at least 10% the rest of the year.
A body in motion tends to stay in motion,
Yeah.
as they say. Thanks a lot, Ryan. Great to see you as always.
Appreciate it, guys. Thank you.